All right, guys, welcome to our first audio guided session. We're gonna walk you step by step through this review to make this as easy as possible for you guys on your end. So let's just go ahead and get started. So chapter 1, types of business activities. So the three big types of business activities that you all are going to need to know for your exam is financing, investing, and operating. The easiest way to think about this is to basically separate the three and look at them one piece at a time. So financing, basically, as you guys have read probably from the review, goes through and talks about dividends paid, sale or repurchase of the company's stock, payment of dividend tax. Financing items are typically things that would be done to shareholders. They're going to be things, like I said, dividends paid and payment of dividend tax. They also have things to do with stock. So the best way that I think about financing is to think about the stock and dividend side, the shareholder side of a company, to help keep that separate in my mind. Moving down to investing. So investing and financing can be confused pretty easily. But investing, basically, the main difference is investing looks at when a company takes on a project, basically. And so the big difference is when a company, for example, invests in plant, property, or equipment, they are typically doing an investing business activity. So we really want you guys to make sure that you understand that investing has to do with long-term assets and basically the acquisition of big plant machinery or other equipment. That's the main difference between finance and investing. Moving on to operating. Operating basically is activities that have to do with sales, cost of goods sold, as well as collecting payments from the customers, as you guys can see from the definition. Operating typically is derived from net income. So think of it as the day-to-day things like day-to-day expenses and revenues has to do with operating. Moving on. So the three big types of business organizations that you're going to need to know are proprietorship, partnership, and corporation. So let's start first with the proprietorship. So basically, a proprietorship is the single most simplest way that you could come up with a business. Basically, the owner is completely liable, as you can see from the definition, and if anything happens, it's all on them. Another way to think of it is just a sole proprietorship. So it's the most simple and the most debt-heavy type of organization that you could possibly start up. A partnership is just add one more. Usually it's multiple individuals. It can be two, so two or more. Usually they call them general partners, but proprietorship, it's usually a single soul who's in charge. With a partnership, it's two or more. And so the general partners are equally all liable for their debts. So that's the best way to really understand that. Corporation is really the most common, and you hear this term all the time. You don't really hear, Bob just started up a company and it's a sole proprietorship. I mean, how many times do you hear that? Usually you hear corporation is the most common, and it's really the least risky because debt and other things are sort of given out to different partners and different owners. It's the easiest to transfer stock, and it's definitely the most common that you'll hear of. But usually corporations deal with larger entities as opposed to sole proprietorship and partnerships. Okay, moving on. Financial statements. So really, this is really the thick and heavy part of this review, really the most important part of Accounting 200. So if you have a good understanding of the financial statements and how they interact and how they connect, you're going to be pretty set. So for the first statement, we're going to take a look at the income statement. So the income statement, as you guys have come to learn, is basically to show to give you an ongoing look at how a company's health and performance is. So it takes revenue, subtracts expenses, including tax, and gives you a net income. And the net income really helps to show the health of a company. Typically, a company with a strong net income is doing well and is pumping at full cylinders. So I gave you guys a nice long definition that really goes into detail. Something to remember with net income is that or that the way that net income connects with the rest of the statements is that, as you can see where I'm highlighting, basically retained earnings, which is derived from net income on the balance sheet, is found by taking the net income, adding the beginning retained earnings, subtracting dividends, and then that gives you your ending retained earnings, which goes in stockholder equity. That's an important connection that you guys need to understand. The income statement also connects with the statement of cash flows. It connects in a way where I'll type it for you guys to see. But depreciation expense is an expense on your income statement. You subtract that from revenue, just as you would materials expense or labor expense or salary expense. You subtract depreciation on your income statement from revenue, but you're going to in turn add this depreciation expense back to your operating section in the statement of cash flows. That's important as depreciation is a non-cash expense as well as amortization. So I'll go ahead and add. I can't type for shit. So depreciation and amortization will be added back in the statement of cash flows under the operating section because no cash is exchanged in these expenses. The best way to think of depreciation is to think about when let's say you were to go to a Ford dealership and you were to buy a vehicle. As soon as you drive it off the lot, it's no longer worth the sticker price that you paid for it. It's now depreciated to, let's say, if you bought it for $20,000, it's probably only worth $15,000 because it's no longer a new vehicle. That's depreciation expense. It's the exact same thing. It's with machinery. So after a year of using a machine that was brand new, it's no longer worth what you paid for. And so you have to discount your assets as it becomes less and less valuable. So no cash is taken away from you with depreciation expense. So you need to add that back in your statement of cash flows, because your statement of cash flows essentially is a statement that adds up all the cash you have on hand, like the actual physical cash that you have. So if you guys have any questions, make sure you post on our Facebook page about that, because that's an important topic. So statement of stockholders' equity, that's kind of I just call it's just the equity of the company, essentially. And basically what needs to happen with the statement of stockholders' equity that you really need to know is that there's two big there's two big parts. There's the stock, which comes in the form of common and preferred. And then really what you guys need to worry about is retained earnings, which we described earlier. Here's the equation I gave to you guys at the bottom. Retained earnings is essentially derived from net income, and you take into account the beginning retained earnings and the subtraction of dividends. So stockholders' equity is your ending retained earnings and then whatever preferred and common stock you all may have on the your example problem. Those are the two main things. As you guys know, or don't know, equity plus liabilities needs to equal your total assets. So equity is a part of the balance sheet as well, in case you guys were not aware. So I'll go ahead and write that. Let's see here. Equity, I guess we can say stockholder equity. Equity belongs to balance sheet with liabilities and assets. Again, I can't spell to save my life. Okay, moving on. Trying to get through this as quickly and efficiently as I can for you guys. Classified balance sheet. This is something that basically helps organize your balance sheet. It breaks it down into current and long term. So I give you guys some examples. So for example, balance sheet classifies when presenting assets. So you have current assets. A current asset is defined and organized by how liquid it is. So the most liquid asset you can have is cash. And so that would always be number one, because liquidity essentially means how quickly can you turn an account or something you own into cash. So cash is what you want to accomplish. So it's the most liquid. Accounts receivable is also a current asset. It's easy to turn some cash that you're eventually going to receive into cash. So that's going to be also a very liquid item on the balance sheet under assets. So when you think current assets, think cash, accounts receivable, things of that nature. So for long-term assets, you want to really think about plant, property, and equipment, PP&E. Those are all long-term assets because they're not very liquid. It's not easy to turn around and buy a $2 million machine and then the next day sell it. It's not a very liquid item, whereas cash and accounts receivable are. Looking at number two, long-term investments. I kind of just explained this, but PP&E, plant, property, and equipment are long-term assets. And then finally, the least liquid is intangible assets, which would be things like copyright. So if you have a company and you copyright it, that's an asset, it's an intangible asset or goodwill. So I'm not sure if you guys have dove into that yet, but if you have questions about that, just let us know on our Facebook page. So liabilities. Liabilities are also classified as current and long-term. Current liabilities, again, are liabilities that are going to have to be liquidized basically soon. So accounts payable, you owe people money. Those are current liabilities because you're about to turn that into cash. You're about to have to pay that account up in cash. Another current asset or current liability, would be unearned revenue. So let's say that someone pays you $100 to mow their lawn, and you promised them you'd mow their lawn in 3 days, and you have this $100, but you haven't earned the revenue. So it's a liability because you owe them your labor. So that's a current asset as well because cash is quickly exchanged. For long-term liability, things like long-term note payable or long-term debt that you may have issued would be, usually with liabilities, it'll say long-term and then the liability, whether it be debt or a note payable. That's the easiest way to decipher between current and long-term for liabilities. All right, let's move on to statement of cash flows. I briefly touched on this, but basically it's broken down into three categories: operating, investing, and financing. I gave you guys some pretty detailed information. So operating is net income. I told you net income is a part of the operating section in the statement of cash flows. So operating is net income plus non-cash expenses. This is where I talked about depreciation and amortization. And then you add those non-cash expenses and you subtract out your changes in assets. So you subtract accounts receivable, the change in accounts receivable, and the change in inventories, for example. So the reason you do this is because if accounts receivable goes up from quarter 1 to quarter 2 by $50, you need to subtract $50 from your statement of cash flows, because that $50 is no longer in cash. So the statement of cash flows counts your cash. You have accounts receivable go up, you're not getting cash, you have an account that goes up as opposed to you getting physical cash. As well as with inventories, if you can't sell your inventory for cash, it sits in the warehouse, and when inventories go up, you have less cash on hand, so you subtract that out. The next thing you do is you add back your change in liabilities. The reason you do this is because if accounts payable goes up $50 in a quarter, you're getting $50 in cash that you have to pay back later on, but nonetheless you have $50 more in actual cash this quarter, so that needs to be reflected in the statement of cash flows, and so you need to add $50 back into your operating section. Again, if you guys have questions on that, let us know. We can go into more depth, but it's a really important topic. So I give a little bit more of the equation. So obviously, if you've bought plant, property, or equipment, you need to make sure that you subtract that out, because you're giving those other firms cash for either plant, property, or equipment, and the cash is leaving the firm. The cash is not coming into the firm. And then financing, like we talked about, if you give out shares or you issue shares of common stock, you're going to be giving out stock and in turn receiving cash. So that will be you'll add that back into your statement of cash flows under financing. But if you were to buy back some of your own common stock, cash is coming out of the firm because you're buying your own stock, so you're going to subtract that. So just remember, statement of cash flows is just a reflection of how much cash is on hand. So again, statement of cash flows can be kind of confusing. If you have any questions, just please go to our Facebook page. I'll go ahead and just write it down on here to make it easy for you guys. So number 5, last point in chapter 1, financial accounting rules. I gave you guys, there's a couple links I gave you guys. I'll go back up a little bit. Under income statement, Investopedia. I'm not sure if you guys know of that site. It's awesome. It's really good. They have interactive videos that really simplify important financial terms, accounting terms, into a fun video. And so I've been posting these on here. So let me know what you think about them. But they're really awesome. They're badass. They really helped me out. And it's fun to watch videos. I mean, no one likes just to sit here and read a review. So check out these videos, especially for this for the GAAP rules and standards. I could have written a bunch of the rules, but this video is really good. And that's really the best way in my mind to learn it. But if you have any more questions about that, let us know.